And look, I know what Grandma told you. I know what Dave Ramsey screams at you until his face turns the color of a glazed ham. Pay off the house. Be debt-free. Sleep on a pile of equity. It sounds great. It feels responsible. It feels safe. But what if I told you that as of July 4th, 2025, that advice officially expired? Because while you were barbecuing hot dogs and watching fireworks, President Trump signed something called the One Big Beautiful Bill Act. I still can't believe that's the official name. We are totally living in a simulation. But hidden inside that bill is a change to the tax code that flips the script on home ownership. Basically, the government just rigged the game. They made carrying a mortgage one of the only tax shelters left for the middle class. And they made a paid-off house one of the most dangerous places to store your wealth. If you send that final check to the bank today, you aren't liberating yourself. You are walking into a trap. You are trading liquid cash, which saves your life, for dead equity, which makes you a target. So in this video, I'm going to show you the new math. I'm going to show you why the IRS rewards you for having a mortgage, and I'm going to show you why paying off your house might be the most expensive peace of mind you ever buy. Although, I get it, debt-free might be the type of peace of mind that is priceless to you. But stay with me for a minute. If you don't like what I have to say, you can have your old life back, guaranteed. So let's look at the One Big Beautiful Bill Act, or OBBBA, OBBBA, which sounds less like a law and more like a noise a seal makes when it bumps into glass. But for years, the standard advice was don't keep a mortgage for the tax break. It's not worth it. And under the old rules, that was mostly true. The standard deduction was high. The SALT cap, state and local taxes, was stuck at a pathetic 10 grand. And itemizing was a pain in the neck. But the government realized something. They need the housing market to keep moving. They need you borrowing money. So in July, they essentially bribed you to stay in debt. First, they made the $750,000 mortgage interest deduction permanent. It was supposed to expire. Now it's locked in forever. Second, and this is the big one, they quadrupled the SALT cap from $10,000 to $40,000 through 2029. This changes everything. If you live in a state with high taxes, California, New York, New Jersey, even Texas with your property taxes, you used to get screwed. Now, you have a 4-year window to deduct a massive chunk of your expenses. But here's the catch. To get that deduction, you need something to deduct. You need mortgage interest. If you pay off your house, your interest is zero. Your deduction is zero. You are literally handing the IRS a tip, more money than you're required to give them. You are volunteering to pay more taxes than your neighbor who kept his mortgage and put his cash in the bank. It's like the government is handing you a golden umbrella and you're saying, no thanks, I prefer to stand in the rain because I like the feeling of being wet. But Matt, you say, I hate debt. I want to be free. Okay, well, let's look at the math, because the math doesn't care about your feelings. Meet Standard Sam. Sam pays off his house. He feels great. He throws a party, and then when tax time comes, he takes the standard deduction. For a married couple in 2025, that's about $31,500. That's it. That's his ceiling. Now meet smart Irene. Irene kept her $400,000 mortgage at 6.5%. She pays about $26,000 a year in interest. She also pays $12,000 in property taxes and $8,000 in state income tax. Under the old rules, she would have hit the $10,000 cap and been stuck taking the standard deduction just like Sam. But under the OBBBA rules, she deducts the full $20,000 in taxes because the cap is now $40,000, plus the $26,000 in mortgage interest. Her total deduction is $46,000. That is $14,500 more than Sam. If she's in the 24% tax bracket, she just saved $3,500 in cold hard cash. Sam paid that money to the IRS. Irene kept it. Why? Because Irene played by the new rule book. And it gets better. Because Irene didn't send that $400,000 to the bank to pay off the house, she still has the money. She put it in a safe, boring treasury bond or a high yield account paying 5%. So she's earning interest and getting a tax break. Sam is earning nothing and paying more taxes. Sam thinks he's free. Irene is actually rich, or getting closer to it at least. But the tax break is just the appetizer. The main course is survival. Here's the truth that the banks don't want you to realize. Home equity is dead money. You cannot eat shingles. You cannot pay for a surgery with the brick. The only way to get your money out of a paid-off house is to ask the bank for permission. And guess what? The banks are starting to say no. New capital requirements, Basel III Endgame, are forcing banks to tighten up. If you pay off your house and then a crisis hits, maybe you lose your job, maybe you have a medical event, and you go to the bank for a HELOC, they will look at your lack of income and say, denied. I see this happen to retirees every day. You have $1 million house. You are a millionaire on paper, but you've got no cash flow. So the bank treats you like you're broke. A paid-off house is a piggy bank that requires a sledgehammer and a 6-month underwriting process to open. Cash in the bank, that opens instantly. If you pay off your mortgage, you are locking your safety net inside a vault that someone else holds the key to. In a financial survival scenario, liquidity is king. Equity is a peasant. And there is one more reason to keep a mortgage that nobody talks about: asset protection. We live in a litigious society. People sue for fun. If you have a paid off house, you look like a juicy steak to a lawyer. 100% equity, that's easy to seize. That's the target. But if you've got a mortgage, if the bank owns 70% of the house, you look like a picked over chicken wing. There is no meat on that bone for a lawsuit. The bank is first in line, and the lawyers know it. And let's talk about the grim reaper of retirement, Medicaid Estate Recovery. If you end up in long-term care and the state pays for it, when you die, they come for your assets to get paid back. And the first thing they look at, your paid off house. But if that house is encumbered by a mortgage, it is much harder and sometimes impossible for them to take. A mortgage is a poison pill for creditors. It makes you unattractive to the system. And in this economy, looking unattractive is a superpower. Now look, I get it. I know what you're feeling. There is a psychological high to walking to the mailbox and knowing you don't owe anyone a dime. It feels like freedom. It feels like you won the game. But that feeling is a relic of 1990. It's like feeling good about using a payphone. It works, but it's not built for the world we live in today. The system, the IRS, the banks, the creditors, they love it when you pay off your house. It makes their balance sheet look great. It makes their risk go to zero. But it shifts all the risk to you. You are the one with no cash. You are the one with the tax bill. You are the one with the target on your back. So what do? If you are sitting on a pile of cash thinking about paying off that mortgage, stop. Take your hand off the checkbook. Step 1, check the math. Maybe it'll work out, maybe it won't, but check it. Look at your mortgage rate versus what you can earn in a safe investment. If your mortgage is 6% and you can earn 5% in a money market, the cost of that debt is only 1%. And after the tax deduction, it might be negative. The bank might effectively be paying you to keep the money. Step 2, hoard liquidity. Keep your cash accessible. If an emergency hits, you want to write a check, not fill out a loan application. Being debt-free, it's a vanity metric. Being liquidity heavy is a survival strategy. Step 3, the reverse mortgage option. If you are older and thinking, but Matt, I don't have the income to make the payments, this is where the rules get interesting. To get a reverse mortgage, which eliminates monthly payments but keeps you in the house, you usually need some equity, but you don't need to be paid off. In fact, having a mortgage balance can sometimes make the transition smoother. But if you dump all your cash into the house now, you can't easily get it back without costs. The bottom line is this: July 4th, 2025 changed the rules. The One Big Beautiful Bill Act made debt a tool and equity a trap. You need to stop treating your home like a trophy case for your net worth and start treating it like a business treats an asset. Businesses don't pay off cheap debt. They use it to protect their cash flow. But realizing you need to keep your mortgage is just the first step. The bigger problem is that most homeowners are treating their house like a stack of bills instead of a fortress. And you are blind to the threats that are actually coming for it, from hidden tax assessments to title fraud. And that's why I pulled this video out here for you to watch next. It walks you through a simple 60-second asset checkup that reveals the blind spots most people never see until it's too late. You'll see exactly how to run that checkup right here, and how to finally get the peace of mind that comes from knowing your asset is actually protected, not just paid off. Watch this here.